US markets are breaking out and running. Iron ore is still weighing heavily on the Australian markets, while value is emerging in some of the ASX blue chips. This is all in Gary Glover's weekly report. Good morning, Gary. How are you?
Yeah, I'm good, Chris. Good.
So, sunny Tuesday we've got here in Sydney, cold and windy, but when we look in the markets, we've got a lot happening in there. When you look at the report that you've got and you've sent out yesterday morning, the NASDAQ is the most interesting one because over the last couple of weeks, you've been talking about this cup and handle, which you've explained last week and covered in a bit of detail. Now it's jumped up and would we be right to say it's heading towards this red line you've got here as previous high as overhead resistance?
Yeah, that's the way I look at it there. It's had a nice acceleration there the last few weeks. So that's probably the, bit of a technical level ahead here that I can kind of see. And just looking at sort of the, those sort of third years, sort of and years kind of post the midterm year as well. They're kind of more of a climbing year rather than an acceleration sort of year. So they just kind of, they kind of just plod. They're a bit of a plodding year. They're sort of they have little, lots of little pullbacks, all small drawdowns, but it is sort of a bit of a building phase there. So definitely some points there where you kind of accelerate and push on. And look, maybe the NASDAQ keeps going here. It could do. Just looking at those sort of third years historically, they're sort of kind of, just a bit more sort of smooth in their movement. So I just expect a few little pullbacks, a few little drawdowns along the way. But the one thing that, as we highlighted there a few weeks back, might have been a month ago there, Chris, was that, most of those sort of third years, I think, might have been 5 of the last sort of 6, and maybe sort of 7 or 8 of the last 9. Those years just don't have big pullbacks in the market. As sort of as we sort of get past this sort of May period, we only sort of saw 2 to 5% drawdowns throughout the whole year. So just small pullbacks. So and that's generally a result of people being too bearish, being underweight, being fearful at the lows, and then being reluctant to get back in again. And now this market's running, and everyone's, we've seen how many recorded short positions there have been. We've seen how many, how underweight most sort of funds generally are, how underweight hedge funds definitely are. So everyone's going to be playing a bit of catch up there. That's why I sort of think probably any sort of any reasonable dips there will be bought moving forward here. So it all looks pretty constructive there, Chris. I mean, we've just got a lot of classic sort of technical patterns here. Obviously the noise is still a bit negative, but we're starting to see a little bit more positivity now as the price action is moving here. Some sort of sectors are really getting a bit lively, particularly that NASDAQ there. Obviously the AI space is what everyone's talking about it maybe in the same effect as the internet. So that's a big call. But yeah, look, I wouldn't be getting too pumped up about any one sector there, but yeah, it does appear to have a bit of legs there, and but I think you'll sort of see a few little dips along the way here. So I think just a little bit of patience will be required.
Well, if you're talking about technical setups and those driving, if we look at the SP500 in your report, you've got some overhead resistance there. It seems to have been really toying with just under that high, touching over the high. And you mentioned a stage 2 breakout. Is that hailing back to the Stan Weinstein 4 stages that you're talking about there?
Yeah, I mean, look, it's just the classic sort of chart there. Sort of, you break out, you come back and retest the zone, and then, you go back to the high, you congest under the high, and then you finally push through. So there's, if we look at our textbook sort of, ideal buy scenario, sort of the, start of stage 2 analysis, this is just a textbook sort of setup here. So, I think this is positive there. It's just not a market in a hurry here. But as we sort of made, it does take time to sort of build, to get a few higher lows, and then you will sort of pop up a little bit. But I just sort of know these sort of years, the third year is typically just, they're more of a robust year, but just they're sort of, it's got more of an ebb and flow there, just not they just don't take off there like other bullish years, and the market there. So sometimes your sort of fourth, fifth, and sixth years, they can be pretty, like your fifth year, often referred to as year of the extension there. That's when you can see the market really open the shoulders and get moving. I think the average return in the fifth year is about double or triple the average of all other years. So it's just one of those years where the market does get pretty aggressive. So this is just not a year where you're getting super aggressive, but it is a year where we just climb, with pretty small drawdowns. So so everything looks pretty constructive there. It's interesting, those charts there, sort of the NASDAQ and the S&P and the Dow over the last month have not performed consistently. They've been doing different things. And even look at the Russell 1000 and 2000. I mean, the small caps have been underperforming here as well. So all those indices have been acting quite differently. So when I looked at them this week, they all sort of told me that they might do different things as well. And that's not often the case here, but it definitely has been the case here recently. So I mean, the S&P looks pretty constructive to me, sort of, kept that consolidation pretty tight under the high, now pushing through. That's a positive sign. So I don't see anything sort of negative in there. I see it quite positive. And the Dow Jones as well sort of had that really nice, it's sort of been probably the weakest of all the indices. That sort of 5 weeks there has still stayed pretty tight in the range, stayed above the 50-day moving average. It's probably only come back half of the range in that same amount of time here. So rallied 5 weeks, pulled back 5 weeks, hasn't come back much. Pretty constructive. That's like a classic sort of, broadening pattern there before we sort of go again. So just that looks pretty constructive to me as well. So maybe we'll see, a little bit of a shift. Might be a little bit of money come out of growth. Maybe it'll move back into value for a bit. Maybe the Dow will pop here, have a bit of a run. And then it might switch back to growth in a month's time here. I just think we're just going to, all those indices still look sort of constructive to me.
Well, if you're talking about indices doing different things, and just off the Dow, it's had 3 or 4 weeks up and then just 5 weeks down and tighter consolidation. That echoes what you were talking about on the ASX last week. We were doing the Bill McLaren counting lessons where we had the market go up for 4 weeks. It then came down for 4 weeks. But this is a pullback that's been a much milder pullback, and I'm reminded of in the previous weeks and months, you've been talking about learning from the counter trends, and they can tell us more about the overall trend itself and how they behave in the counter trend. Could that be something happening here on the Aussie?
Yeah. So look, we didn't get the reversal up here on that 5th week, which I sort of view as that's sort of probably slightly negative. We've still got sort of some of those iron ore stocks there, BHP, Rio, Fortescue. They're sort of still sort of struggling there. If you have a look at those stocks there, have a look at the up days and the volume, and then have a look at the down days and the volume. There's just a big disparity there. So, until you sort of see, nice big green bars on big green high volume bars there, you just got to be concerned about that sort of that pullback there. Didn't see, that's not we got a down week there, but the volume was sort of less than the previous week, or probably the previous 2. So not heavy sort of congestion there. So that probably tells me this is more likely it might sort of drift here for another few more weeks there. I mean, just a technical observation over the years is sometimes these corrections, they're sort of, if we rally, say 3 or 4 weeks, we'll pull back the same amount. And if it lasts a bit, if it lingers a bit longer than the same amount, it'll usually go twice as long. So if the market goes 4 weeks, it might actually congest for 8 weeks. So most common would be for 1 for 1. The second most common is to be twice as long in the congestion zone than the rally. So if it rallies 3, maybe congest for 3 or 6. If it rallies for 4, it'll congest for 4 or 8. Those are the 2 most common sort of setups there. So this suggests to me we might just meander sideways here for a couple more weeks, maybe sort of 8 in total, and then maybe we get going there. And that might just sort of align with these sort of commodities sort of going through there. maybe they're going to be weak here for the next 3 weeks here, and take a little bit of time to find a low here.
Well, that's probably time to jump into the ASX. Look for some possible trading shares in this week. Looking into the report, you've got Bank of Queensland, which is a name you'd mentioned a few times before. You've been looking at it from a yield perspective on its historical price to earnings ratios as well. So just quickly, what is that historical price to earnings, and why does that matter for a blue chip that pays a dividend?
Yeah, look, I've just, in the past there, I've looked at sort of, particularly the top 50 sort of stocks there, whose businesses don't change much. So, your Bank of Queensland, your Wesfarmers, your Woolworths, those sort of businesses are, what they do from one year to the next, there's not much that sort of changes within those businesses. And historically, they might trade within on an earnings multiple. You'll get sort of periods there where the earnings are stronger. Might trade on a slightly high multiple. Get periods there where it's a bit weaker. They'll trade in a slightly lower number, but over a 10-year period, they might trade in a band. So something like CommBank, I think, used to sort of trade sort of somewhere between like 11 times and up to around 30.5 times. So if it ever came down to 11 times, you'd sort of buy it. If it got to like above 30.5 times, you'd be selling it, because that's sort of like your sort of 90 percentile sort of range. So you just notice certain bands there. So there's no guarantee that, the thing about those sort of bands, they're just 90 percentiles there, Chris. They, even though you might be, at the lower end of that band, you can still go lower. You're in the, but at least saying, if you're actually able to buy the stock on the lowest PE for the last 10 years, then you're comfortable buying that, then there's some sort of value there. So at the moment here, just a few stocks that are sort of getting down to some sort of, those sort of serious sort of, lower edge percentiles. And I think here, oftentimes, it can be a trap buying the PEs, because PEs, when they compress, it usually tells you that maybe the earnings are going to be compressed as well. So that's why sort of sometimes you buy these mining stocks on these low PEs, high yields, can be a trap, because that's the sort of the sweet spot, and usually the peak of the cycle, and it changes there. Those businesses do change a lot, the commodities, but banking, retail sort of stocks, they don't change too much. Pressures can come there, but yeah, looking for businesses that don't change. But I guess Bank of Queensland now, I think it's sort of, we're down to sort of single digit PEs. The yields sort of upwards around sort of 8%, so pretty high yields there. If you price in a little bit of bad news, if you price in some depreciation in the earnings, and you basically give it a haircut and look at consensus and stuff there. If you look at consensus and then that's sort of, say 10 or 15% lower, then you take your 10 or 15%. If those multiples are still well below the historical averages or historical lows, then there's some value there. So a couple of stocks that really are jumping out to me at Bank of Queensland and Harvey Norman, if we look at historical valuations. And so Bank of Queensland, they're around that sort of 65, 70 mark there. That's pretty compelling sort of value there. Can it get cheaper? Of course it can, but we're buying it sort of down the bottom 10% of the sort of historical price range. So definitely some value emerging here. Obviously technically we can be risky buying sort of lows here, but I find these sort of more consistent sort of businesses where they don't vary too much, don't have the sort of wide-ranging cycles that other businesses do as safer buys. And I think banking is one of those things there. I think once they get down to some pretty attractive yields there, there's definitely some value emerging there. So I think, this is 3/4 of the range here, I think, on the weekly, just starting to sort of show some support here. The volume starting to increase there. So that's sort of possible signs of accumulation there. So just think there's some value there around that sort of 570 mark there.
Well, you're talking about companies that don't vary too much. Just to shine a light in the other direction, Whitehaven Coal is probably a good example that does vary a lot. Their margins blew out massively because of the commodity prices. As you're saying, Bank of Queensland, their operations and margins, well, they do vary, nowhere to that extent. Harvey Norman, Harvey Norman's the other one you've got here. Now, they're a little bit different in the sense that they will ebb and flow more with the consumer cycle, quite possibly a bit further down the tail than a bank. But is that a similar sort of thing? You're looking at the value emerging on the same principles?
Yeah, so I can see earnings, consensus earnings have sort of got earnings dropping off about sort of, I think, might be 15% for 1 year, and I think close to 40% for the 2 years. Obviously, coming out of that COVID sort of sweet spot, we're all at home just buying furniture. So that sort of numbers were elevated. And then now everyone's sort of, got recession on them, like high interest rates, obviously post there. So consensus is really showing quite a significant sort of cooling off. But if you sort of look at the consensus earnings, and that's, if you're sort of taking a 40% haircut off the price there, and the PE is sort of still under 10, which it is, and then historically the stock trades between 11 and 15, then there's still some value there. And possibly we're pricing in, we're already pricing in 2014's drop in earnings here ahead of time here. And the one thing is that the market has been very wrong about the softness and the weakness ahead. Actually, the data has come in much stronger than everyone's been expecting. So everyone's been sort of expecting a cool down and the worst, pricing in a lot of the worst side here. So it feels like the market's already priced in the worst case scenario here. And that, for me, looking at it historically, that's cheap historically. Can it come lower? Of course it can. Obviously, sentiment can get weaker. But that's why sometimes you're looking at, I look at a bit of quant stuff there in terms of sort of earnings, things like that. So it can sort of add some light there. I mean, I remember sort of years ago sort of buying the banks when I think ANZ might have been around about 9.5 times earnings, and that was probably the lowest multiple the stock was trading on, about 10 times. And it was a bit of a cycle low for me at the time. I thought the market was sort of, kind of near an important low, and definitely some value there. And if you feel like if you're buying one of the cheapest multiples you've ever seen in the last 10 years, you can kind of buy with a little bit of confidence there that you're not paying a high price for them. So again, they can come slightly lower, can squeeze you a bit more, but I think eventually the price will normalize and recover.
Well, that's a good point to be looking at these good value, well-known household names. We move down the ladder a little bit further. Well, there are still some big names in the report. You've got Dicker Data in here once again, and look like it might be slowing down. What's happening here? It sort of broke out and then has pulled back along that line you've got going here. So what is the line and what's happening?
Yeah, so I like to, apart from sort of looking for value and stuff there, I do like to, I look at the technicals all the time. The technicals are important to me. So, I'd like to sort of see a series of high lows. So, I'd like to see, the volume emerge at the lows and volume pull back on the pullbacks, and then just some technical signs there that we are a low. So that's what you're sort of looking maybe to combine sometimes those sort of value stuff there. But just this one here, I noticed Dicker Data, like a lot of stocks there recently, went down and made a new low, and it was only there for a day. And there was a bit of a reversal on that day, some decent volume there. And actually, we got a pretty nice impulsive rally there. And this is a sector which has been kind of leading, Chris, as well. So it's sort of one of those leading sectors. Has pulled back here. But the volume's been pretty light on that pullback. And just come back to that sort of, this is kind of a weekly sort of range here, but come back to the sort of range setup there. This might be an area where we might find support here, maybe a first high low here. So I'd really like this at the low. And now we've sort of got a potential first sort of high low here. So, I view this as sort of constructive there. Just probably want to see a bit more volume come in here. But it is a sector that is sort of starting to, get a bit of traction there. So, it's just not the strongest stock in that sector. That's the only negative. It's oftentimes we're looking for stocks with the,
the leading group.
Yeah. So it's sort of, you might call it a sister stock, and maybe, it's in one of the leading sectors at the moment, but it's not the leader.
Well, that's an important distinction to make when you are looking for trading leaders, but it does have sister strength, and the thematic is pushing. If we move to another one, it is a household name, Lendlease Group, big well-known company on the ASX, many decades. Your consolidation at higher volumes, could we be looking at a triangle or a VCP, or what's on the formation here?
Yeah, just noticed a lot of these sort of building construction stocks are starting to improve, Chris. So obviously, we we had all that sort of rate rise and impending recession, which was all pretty negative for those, and they were all pretty weak into sort of, particularly into March. There was some definite weakness in a lot of those stocks there, but a lot of them have sort of started to build here. And obviously now we're all talking about immigration improving here in Australia, and then obviously being a housing shortage there, and that's sort of probably positive for construction. I saw a few building companies have sort of reported there, and probably a little bit more favourable than the market was expecting as well. So just notice these building stocks starting to get a little bit of traction there. Technically there, we've had a nice little impulsive sort of rally out of that March low. We've had a bit of a pullback, another rally up, another pullback there, just sort of getting shallow there. Just look at the last 4 or 5 days on that little pullback there, Chris. It's just no volume there. So really drying up here. So just like seeing these sort of stocks that are sort of, getting shallower and shallower and no sort of volume. And that's been typical of a lot of stocks here recently, particularly the ones that are breaking up and moving higher. So it's okay to have a pullback. But if we're seeing very, very light trading, light, activity on those pullbacks, not a lot of selling there, that is constructive there. So, it looks pretty constructive to me.
I'm just thinking about one of the lists that we've been working on together is the coils list. And one of that criteria is, some of the criteria is what you're talking about here, but I'm noticing the 10-day moving average, the 20-day moving average, and the 50 are kind of getting closer. So that's something you look for as well?
Yeah, definitely. Yeah, and I do like them sort of sitting above the 50 as well. Just, nice to sort of come back and maybe congest back towards the 50. And if the other moving averages are sort of coiling up and tightening up as well, that's quite good. And I just like to see very low participation on the selling too. So it's good to have a bit of a pullback, a bit of a pause. If there's no aggressive selling in that pause period, then that's what we're looking for.
That's a nice short list to be looking for, and a good one for the watch list. We move to the last one in your report. We've got Pexa Group, which was an IPO a year or so ago. It is kind of operates in that property settlement space, almost a monopoly, working with a lot of the government, semi-government kind of transferred into this business. What's caught your eye on this chart for Pexa?
Yeah, I just like the fact that the last sort of rally there has taken out the previous swing high. So that sort of negates sort of, the sort of downtrend here. And then there was some pretty good volume there, Chris, as well. So that was probably the most robust volume that we've seen probably for the last few years. So it's actually pretty aggressive, pretty strong volume through there. And then again, we've had this pullback there, and the volume again the last few weeks, the volume has really lightened up here. So pulling back here, and we've only come back the same. So we've literally gone up about 5 or 6 weeks, have pulled back 5 or 6 weeks. I don't even think we've even come back half of the range. So it's holding pretty tight here, bit of a corrective manner there. So that's looking quite good. The interesting thing with Pexa, actually, which I didn't realize there. So if you actually look at consensus growth numbers there, market's expecting this thing to grow pretty quickly here next few years. So looks like they're sort of probably trying to roll this sort of settlement platform out, not just sort of here more so in Australia, but actually sort of globally as well. So it'd be interesting actually, maybe might be sort of something like computer share sort of, kind of rolled it sort of model out into the US and stuff there and did pretty well. So this is definitely one to keep an eye on there. Sort of everyone's expecting this thing to grow here. So just, could be one to keep an eye on there. We've been sort of seeing here recently the stocks that are still growing here, and that are sort of moving away from sort of running at a loss and moving into break even and to profit. They're the ones that are really sort of popping here. So this Pexa is pretty interesting to me.
Nice. Well, there's some very good companies to watch for the week ahead and some great analysis of the indices. At that point, we say thank you very much for the insights, Gary Glover from Novus Capital.
Thanks, Chris.
Gary mentioned a lot of things, his technical reports, his different strategies, his analysis of whether it's presidential cycles, decennial cycles, inflation, etc. There's a whole playlist on the right-hand side there. There's also the Friday list. Gary's talked about a few companies that are coiling, compressing, and they've been on the launch pad and now hitting the top momentum stocks. He goes through the top 30 momentum stocks and the top 30 launchpad stocks every Friday. That playlist is on the right. finally, Gary's Twitter handle is over there on the left.